Next up is Dustin calling from Medford, Oregon. Dustin, welcome to the show.
Hey, Peter. Thanks for taking my call this morning.
Thanks for calling.
So I kind of have a question about interest rates. Right now the Federal Reserve is setting the rate, but can you give me a more detailed explanation about, I guess, how interest rates would function in a more free market environment?
Well, sure. Well, the interest rate would be set like any other price. I mean, there's no government agency that determines what the price of a cell phone should be, or what the price of a pair of tennis shoes should be, or, all these prices are determined by supply and demand. And interest is the price of borrowing money. And it's determined by the supply of savings to be loaned out and the demand to borrow those savings. And just let the market set a rate. And the Fed doesn't have to do it. And the market will set a rate, obviously, that's going to be quite a bit higher than the rate we have today. The problem with the rate being so low today is the government has distorted savings and borrowing. Not enough people want to save because the rates are so low, and a lot of people want to borrow because the rates are so low. And so we have this big gap between the savings and the borrowing, which is now being filled with a printing press. And that doesn't work. This way leads to disaster. We need to have a market mechanism to set interest rates so we have the proper balance between savings and consumption.
Yeah, and I agree with that 100%. So would the interest rate, would it fluctuate bank to bank? Would each bank have a different rate then?
No, the rates, depending, now, if you got the government out of the banking sector, right, if the government no longer insured deposits, then yes, banks would have different rates depending on the perception of safety of the individual banks. So safer banks that had better balance sheets might offer lower yields than banks that were riskier. But in an environment where the government is guaranteeing all the bank deposits, then it really doesn't matter. The only thing might be, do you get free checking? How many ATM machines do you have? Can you use your debit card? There might be other things that might, at the margins determine slight differences between the interest rates. But in general, no, the rates would be pretty similar throughout the industry, and they would be a lot higher than they are today.
Yeah, I agree for sure. It would just be weird going to a bank, if, let's say, the FDIC were dissolved and, you put your deposits, at your local bank. It would be really strange, I think, a strange concept for people to think that those deposits weren't insured by the federal government. That's just a strange concept, I think, for people today.
Well, people would now be concerned about where they put their money. And it doesn't mean that the banks wouldn't be insured. They might buy insurance in the private sector. But if they were going to buy insurance, let's say from a Lloyd's of London or, a big company, that insurance company is going to audit them a lot more responsibly than the FDIC would be. After all, it's their own money that's on the line, and they're going to make sure that they're doing a good job. So there still could be insurance in the banking sector. It would just be provided through the private sector, which would be a much more reliable way of doing it. It would condone itself to a much healthier banking system. But, of course, there could be banks run by very reputable people that don't have insurance, that advertise how safe their banks are. You could have independent rating agencies, not licensed by the government, but kind of like a Consumer Reports that can come out with its own version of banks and which ones are the safest. You can have, how Frommer's, they put their stars on restaurants or what the numbers, how they rate them, and you can get a guide. There might be companies that would do that with banks, and the banks that had higher ratings or more stars would be able to attract more deposits. I have no doubt in my mind that we could have a more solvent banking system if we got rid of all those government guarantees and replaced true free market discipline. After all, people don't want to lose their money, and they're not going to deposit it in a bank if they think they're going to lose their money. So I want the people to have money on the line, their own money. That's the best regulation to make sure that the banks that get that money are safe, not when you abdicate the responsibility to some third party in government who couldn't care less about individuals and their money, and who was just making decisions based on what's good for him politically.
Right, I get that.
But anyway, Yeah, well, hey, thanks for your call. It's an interesting topic. Anyway, we're up against a break. We'll be back. We've got another half hour coming up of the Peter Schiff Show, so stick around. We'll take more calls, 855-4-SCHIFF. Don't go away.